Today, we're going to talk a little bit about self-storage and small industrial business parks. See if it fits in your portfolio. I know Keith talked a little bit about it earlier, so I'm going to go over just a few slides that kind of highlight why we think it's a good time to be in the market. Our model may not be a fit for everybody, but hopefully there's someone out there that likes our approach, a little bit different. We're a private investment company based out of Austin, Texas. We focus on alternatives, but right now, for about the last 8 years, exclusively small bay and climate control storage, ground up construction. Let me ask first off, has anyone in here invested into storage or small bay industrial before? Raise your hands. Okay, quite a few. Okay, so there's a lot of different ways that you can go into the sector. And I'm just gonna go more of just kind of an educational approach on it today to see if it's a fit for everybody. First off, we like storage. Our clients are at the point that they're walking away from their careers working. They're trying to supplement income, build up residual cash flow for that time when they eventually retire. So we feel it's a good fit because, storage it's always consistent. It's been very recession resistant, predictable, I guess you could say. We just don't have the volatility of a lot of the other investments out there. Some of the reasons we really like it, you got extremely low overhead and operational cost as compared to like a multi-family where you're just constantly investing more capital to keep those, upkeep and tenants moving in and out and having to, capital intensive, I guess is the best way to say it. So it's very operational friendly. I think we average about 10 to 12% is what we consider our overhead cost on maintaining. And then on the sales side of it and the profit and cash flow, we've actually averaged in the industry about 65 to 75% of every dollar is profit. So it's got a good margin, very low overhead, and that's really what, some of the key drivers why we focus on that. Flexible month to month, so we can kind of move with the market. As you know, we'll use, again, multifamily as an example. Those people lock in 1 to 2 year terms. So you really can't raise the rents until those terms are up or lower them in a hard market. So we've got that flexibility. We can go month to month, raise the rents as we need to, or lower them to adjust to any competitors or market timing. So we like that flexibility. One thing that really stands out, it's talking to some people at my table earlier. They look at a lot of companies that have been around the last 8 to 10 years. And I was joking. I was like, I think my 13-year-old could have picked out real estate properties over the last, 8 to 10 years and made money. It'd be very hard not to make money the last 8 to 10 years. So we like to focus on companies that have been around, been through the 2008 cycle and see how they come out of that on the other side. And so we are an exclusive capital raiser for my developer called AAA Storage out of Austin, and they've been doing this since 1993. So they've got 32 years experience. They've been through just about every interest rate cycle and economic cycle that you can have, and got a very, very stellar track record. So that's why we've signed with them as an exclusive capital arm. And another reason, so back on 2008, just as a comparison, across the board, most real estate declined 15, 25%, some up to 35%. Storage actually only went down about 2 to 4% back in 08, 09. So when you compare those, it did go down, but much, much less painful than any other sector you would have been invested in at that time. So I know Keith touched on earlier, I think somebody asked me at our table, he thinks that storage may have kind of hit its peak. And so I know he's a pretty good predictor, but there's some reasons out there that we're going pretty heavy into it, and we're actually on the other end of the spectrum. We think the next 2 to 3 years could be some of the best years that we've ever seen in storage, and it really goes to the interest rates that we've seen over the last couple years. You're seeing banks, interest rates are not favorable. A lot of them have even tightened the restrictions where you could used to go out and get 70 to 80% loan to value. Now they've tried to lower those to usually about 60 to 65%. Materials cost have gone through the roof and goods across the board. Labor cost. So what that has really created is about a 40% reduction in new construction of storage facilities over the last few years. And it's even projected to be another 10 to 15% down this year and negative again next year. So what that means, big picture wise, is about 3 to 4 years from now, you're gonna have a lot less supply on the market because of the underdevelopment, over the last couple of years. So that's really what we're timing everything for. Again, I think it belongs in your portfolio because there is a very bright window for storage over the next couple of years because of everything that's happened. Climate controlled storage, we're at an all-time high in households. There's some surveys out there that are talking as high as 30% of the population now use storage in some degree, whether that be boat RV storage, whether that be, personal and climate control storage. But across the board, again, first time we've crossed that threshold, 30% of all households having storage. So that's a huge market. That's not going to change with continued population growth, more cities popping up. So we think there's some great opportunity there. And I know Keith had, again, mentioned it may have peaked. We've actually seen the last 30 days probably be busier than the last year. We've put 5 contracts. We've been approached by 5 different private equity firms. We got 5 properties under contract just in the last 30 days of people buying our facilities. So I think there's obviously a demand there with interest rates trickling down a little bit. I think you're going to see a lot more buyers try to break into the space. And so we're trying to build these properties to prepare for that window over the next couple of years. So this is an example that I like to go over to make sense. People are always asking, in storage, how are you actually making the money? So I just kind of put this chart together to show an example on our yield on cost versus what it costs us to create that product. And so this is just an example of one of our, say, 100,000 square foot climate controlled storage facilities. We just put a flat $10 million construction cost at occupancy fill up over 90%. That should be throwing us off about $950,000 a year of income. Our typical loan on this last year was a 70% construction loan. So we're borrowing, leveraging $7 million. We actually, our investors put up 30%, which is $3 million hard cash. So when we go to sell that property, this is actually an example of one we just sold here last month. We had a sales price at stabilization of almost $16 million. So how that breaks down and is an attractive return to us is that you pay back your bank. We do an interest only 3 to 5 year loans. Second, you've got the equity return of almost $9 million. And so when you take your $3 million cash that we've put up versus your almost $9 million return, you've actually got a net equity multiple there of 2.94. So very attractive numbers, and that's right now current in this environment. Again, property we just sold here last year as an example. And these returns are all net of all fees and carries in our projects. So just to give you an example of, even though the market out there is tight, we don't feel it's a good time to go be looking to acquire properties. That's why we build. If any of you guys have looked on, I know there's somebody at our table, she was a broker, and I said, have you looked on LoopNet lately, like what's for sale, commercial properties? Everything's overpriced, whether it's multifamily or storage facilities. So you can't go buy those. I'll give you an example. One of my clients just bought an $8.5 million storage facility. He's getting a 5% annual rate of return on his money. I mean, I don't know about you guys, but I'm not going to go spend $8.5 million to get a 5% return. Now, the justification is, he's looking to raise rents over time, do some value add, just the whole game, but still to spend that kind of capital and start off day one, everything else is projection. Maybe it does work, but at the end of the day, all these guarantees of 5% he's making, that's pretty pitiful. So that's why we don't do any acquisitions of existing properties. We prefer to build in this market, new construction just makes more sense. Other than that, again, I said earlier, our model doesn't work for everybody, but I do think storage, small bay industrial does belong in everyone's portfolio of some degree if you're looking for passive cash flow, a little bit of recession-resistant income and predictability. So anyone has any questions, feel free to reach out. Be glad to visit with you.